Static versus flexible budgets. Let's quickly define budgets. Budgets are an organization's plans outlining how its resources are intended to be used. Static budgets. Static budgets, an organization's plan based on one level of output. For example, 12,000 units produced and sold. Flexible budgets. Flexible budgets are like the static budget prepared with a different level of output. So all other budgetary assumptions are the same, but the level of output instead of 12,000 units, for example, might be 10,000 units. Let's now look at some key terms. First is variance. This is the difference between actual or realized and budgeted results. Then we have something called management by exception. This is the practice of focusing attention on areas not operating as expected or as budgeted. This would mean looking at variances, and we call this variance analysis. Variance analysis is discovering why actual results fail to meet expectations. For example, they are greater or less than the budget. Some more key terms. We have something called a favorable variance, often abbreviated with the letter F. So a favorable variance, or F variance, results in operating income that exceeds the budgeted amount. An unfavorable variance. An unfavorable variance, or U variance, results in operating income that is less than the budgeted amount. And a few more key terms. We have something called the static budget. This is based on one level of output. It is not altered after it is issued, even if circumstances change. And then we have something called the static budget variance. This is the difference between the actual results and the corresponding static budget amount. This is the simplest level of analysis, a super macro view of operating results with no detail or very little detail. So let's go back and discuss the static budget, and we'll wake ourselves up a little bit with an example. Now, before we get into the example, let's take a look at a timeline of events that a business might have. So there's time. We'll split it into two periods. On the left, we'll have the current period. And on the right, I'll just call that the next or the following period. Now, if you look back to the left at the current period, near the end of the current period, a budget is prepared for the following period. You can call that the static budget. Now, as time moves on, the following period will eventually become the current period. And the current period, at some point, we will have some actual results for. If we were to compare the actual results to the static budget prepared for that same period of time, we will see that they are not equal. This is because the static budget was prepared long before the period ever happened. We can call these differences, if we are comparing the actual results to the static budget, the static budget variance. Let's look at a textbook example. We'll make some space, and here's the example. We have here the actual results of operating income are 25,000. If we go to the far right, we could see the static budget amount for operating income is 262,000. That is a big difference. The actual results are 237,000 less than the original expectation. Because this is not what the business would desire with respect to operating income, we label it with the U, calling it unfavorable. Some textbooks refer to just looking at operating income as level 0 analysis because it provides some detail, but really not very much. We can get more detailed with something called level 1 variance analysis. Here, we start to look at more line items, but we still are basically comparing the actual results to the original static budget amounts, and then we calculate the difference between them. If we take a look at a jacket company and they have sold 10,000 jackets, but they were expecting to sell 12,000 jackets, that is a difference of 2,000, and it is unfavorable because a business would like to sell more. Let's look at another line item, such as revenue. If we look at the original expectation, $2,160,000, that is less than the actual revenue, $1,850,000. And so the variance of $310,000 is labeled unfavorable because a business would want to sell or have more revenue, not less. So this is an unfavorable result. We can take a look at our variable costs as well. The expectation was $1,188,000 compared to an actual result of $1,120,000. So the actual amount of expenses are less than what was expected. So this would actually be a favorable result because spending less or incurring a lower amount of costs is a favorable thing or a more desirable thing for a business. If we look at our contribution margin, again, the business was expecting 972,000 in contribution margin. The actual result was 730,000. This is less than what the business was hoping for. So that is an unfavorable result. If we look at our fixed costs, the business was expecting to incur 710,000 of fixed costs. They actually incurred 705,000. So because this is a lower than expected cost, the result is favorable. And finally, we can look at operating income, which we looked at earlier, and we could see that the total operating income realized is 25,000 compared to 262,000 that they were expecting. Again, that is 237,000 lower than expected, which, because we are talking about operating income, that is an unfavorable result. We would refer to the $237,000 unfavorable variance as the total static budget variance. That's when we take all line items into consideration. And as a reminder, the letter F is used to denote a favorable effect on operating income, and U is used to describe a variance that has an unfavorable effect on operating income. Now, that is basically the entire static budget. We can now look at the flexible budget. And once again, we will look at an example. We can begin by thinking about a business that has actual results for a period. That same business would have prepared a budget called the static budget for the same period. And as we discussed earlier, we know that those two amounts will not equal. They do not equal for many reasons, including the fact that the level of output for the actual results likely differs from the budgeted level of output. In our example, the level of output for the actual results is 10,000 units, whereas the level of output for the budget was 12,000 units. And if we compare the two, they do not equal, which means a business might benefit from having a more useful standard of comparison for the actual results. And that is where the flexible budget comes in. The flexible budget is like the static budget prepared with a different level of output. So the flexible budget, if it was to be created for the purposes of analysis, would be created based on a level of output of 10,000 units. And if we compare that to the static budget, we'll see that that is a different level of output. The original assumption was 12,000 units. This means we have a difference between the flexible budget and the static budget. We call that a volume variance. The volume variance is the difference between the flexible budget and the static budget due to the difference in volume, 10,000 units versus 12,000 units. If we take a look at the flexible budget again, and then look to the left in the actual results, the differences that we will find between these two would be called the flexible budget variance. Now, there is not a difference of volume here. They are both sitting at 10,000 units. The flexible budget variance is the difference between the actual results and the flexible budget. These differences arise due to variances in rates and efficiency. We will talk about those a bit later. Let's take a look at another textbook example. Here we are. We have our actual results, we have our flexible budget, and we have our static budget. In between, we have our variances, the sales volume variance and the flexible budget variances. For those that need some assistance with calculating, we can take a look at these labels to calculate each particular column. For now, we will assume that the static budget is given to us, and the flexible budget is something we can calculate. And then the sales volume variance will be a result of taking column 3 and subtracting column 5. Actual results will be given to us. And then the flexible budget variance we can calculate by taking the actual results in column 1 and subtracting the flexible budget results in column 3. Let's begin by taking a look at the number of units sold. We are given or told that the original budget or the static budget expects 12,000 units sold, but the actual units sold are 10,000. And so a flexible budget is created to reflect the actual results, but maintain all other static budget assumptions. The volume variance will be 2,000 unfavorable because 10,000 is less than 12,000, and that is an unfavorable result. If we now take a look at revenue, we can take a look over at the static budget here to the right, and we can determine how that number was calculated. The static budget was prepared assuming $180 a unit. And we know that if we take 2,160,000 and divide it by 12,000, we get 180. With that information, we can probably calculate the flexible budget. And so the flexible budget must be 1.8 million, 180 times 10,000 units. The sales volume variance can be calculated. It is unfavorable because the units sold and lower revenue is not what a business would want. And if we took 1.8 million and subtract 2,160,000, we would see that we get 360,000, and that is unfavorable to operating income, so we will mark it with a U. Now, if we take a look at the flexible budget, just as a reminder, the flexible budget is prepared like the static budget with a different level of output. So it's still $180 a unit. That is a static budget assumption, but we multiply it by a different number of units, 10,000 units, and we get $1,800,000. We then compare it to the actual results, and we end up with a flexible budget variance. What does this mean? Well, the flexible budget is favorable for revenues because the actual revenue is higher than they would have expected for sales of 10,000 units. So this variance is favorable because for sales of 10,000 units, they would have expected 1.8 million in revenue. They managed to actually generate for sales of 10,000 units, 1,850,000 in revenue. That's favorable. And then I'll ask you to please take a note here and take a look at the units sold for a flexible budget variance. Well, there is none. And there is no variance for units sold because the flexible budget is prepared for a level of output that is equal to the actual results. So the flexible budget is prepared for 10,000 units, which equals the actual results of 10,000 units. Both of those numbers are different from the static budget, which was prepared for 12,000 units and was prepared long before this period ever began. If we now take a look at our variable costs, We can go ahead and focus in on the static budget. Let's say this number is given to us, 1,188,000. We can make some calculations to determine what the budgeted assumption was. The static budget was prepared assuming $99 a unit. And we know that by taking 1,188,000 and dividing it by 12,000 units. Therefore, the flexible budget must be 990,000. We take that $99 a unit and multiply it by 10,000 units. We can then calculate the flexible budget variance. The flexible budget is an unfavorable for variance for variable costs because the actual costs are higher than they would have expected for sales of 10,000 units. Okay, so this says the flexible budget is unfavorable. It's referring to the variance. The flexible budget variance is unfavorable because variable costs would have been expected to be 990,000 for sales of 10,000 units. But for some reason, the variable costs are 1,120,000 for sales of 10,000 units. That is not desirable. An expense that is higher than otherwise expected is not a desired result and is therefore unfavorable. Let's continue. If we look at contribution margin, again, the static budget number will be given. We can calculate the flexible budget contribution margin by taking the revenue, subtracting the variable costs, it equals 810,000. And if we compare 810,000 to 972,000, that is a $162,000 difference. And because this is a revenue or a contribution margin line item, that is unfavorable. We don't want this number to be lower. Higher is better. If we compare 810,000 to the contribution margin actually achieved, you can see that once again, it is unfavorable. Why? Because the actual result of 730 is $80,000 less than what the business would have expected when they budgeted, even if that budget was adjusted to 10,000 units. They would have expected 810,000 in contribution margin. They only achieved 730. That is an unfavorable result. We can now look at fixed costs. Again, we'll look at the static budget and we will assume this number is given. This business was budgeting 710,000 in fixed costs. If we assume that those costs are budgeted and fixed, then even for 10,000 units, the fixed costs are likely would have been budgeted to be 710,000, meaning no volume variance here. However, they actually only incurred 705,000 in fixed costs, so that $5,000 variance is favorable. They incurred a lower cost than they expected. Operating income, we've seen some of these numbers before. Let's go through them again. Static budget number is given, 262,000. When compared to the flexible budget number is 100,000, so the difference is 162,000 unfavorable because the income is lower, and it is unfavorable solely due to volume. So you can say by virtue of selling 2,000 units less than expected, operating income is $162,000 lower than expected. We can work our way over to the left and see the actual results are only 25,000, which is still much less than the expected 100,000, even when the budget is adjusted to 10,000 units, meaning we have another unfavorable variance. And this means even after taking the difference in volume into account, we are still 75,000 lower in operating income than the business would have expected. That's an issue that they'll have to explore later. So what do we call all of these amounts? Well, over here, 162,000 unfavorable is the total sales volume variance. The 75,000 unfavorable is the total flexible budget variance. And if we add the flexible budget variance to the volume variance, that will equal the total static budget variance of 237,000 unfavorable. Now, before we move on to another lesson, let me ask you a question. If we take a look here, operating income for the actual results is 25,000. For the flexible budget, we're looking at 100,000. And so there is a difference of 75,000. This we already know. But if we look at the level of output, the flexible budget, it has 10,000 units is what it's based on. And the actual results were 10,000 units. So if both the flexible budget and the actual results are based on the same level of output, one might start to wonder, operating income is different, but why? You might be asking yourself, if they are both for the same level of output, 10,000 units, why are the flexible budget results different from the actual results? Why is there a flexible budget variance in the first place? Well, a flexible budget variance exists for two main reasons. One is we have something called a rate variance, and two, we have something else called an efficiency variance. Let's quickly define them. The rate variance on the left. The rate variance is the variance that results from the actual cost per unit of input being different from the budgeted cost per unit of input. For example, the cost per direct labor hour. It might be a different cost actual compared to the budgeted assumption. That could create a difference even if they are based on the same number of units, 10,000 units each. Now we can look to the right, the efficiency variance. The efficiency variance is the variance that results from the actual quantity of inputs used being different from the budgeted quantity of inputs used. For example, the number of direct labor hours. So maybe they budget a certain number of labor hours per unit, but in actual fact, they use a different number of labor hours per unit. That would result in an efficiency variance. They were either more or less efficient with their hours. So if we go back to where we started, the static versus the flexible budgets, what have we really learned? Well, the flexible budgets provide more detail. There are a few main things to remember. One, they are like a hypothetical budget that would have been prepared at the beginning of a budget period if the actual output was known at the time. So in our example, if the business knew that they were only going to make and sell 10,000 units, they would have budgeted for 10,000 units instead of 12,000 units. Then two, the flexible budgets allow for more meaningful comparisons between budgeted data and actual results. This is because we've essentially adjusted our original assumptions to a different level of output that now matches the actual results, so we can successfully isolate volume variances versus other variances. We'll cover these other variances in another lesson, but for now, I will say thank you for watching, and may your journey be joyful.
Yo, listen up, class, it's time to get started. We're dropping finance knowledge, so don't be hard. Static, flexible budget variance, right? We're gonna break it down and keep the numbers tight. First up, budgets, yeah, you know the plan. Outlining resources for the whole biz span. Static budgets locked on one output level. 12,000 units set the score to settle. But wait, here comes the flex, a budget that's adaptable. 10,000 units, now the plan is more practical. Variance analysis, we're digging deep. Favorable or unfavorable, the numbers speak. Management by exception, that's the key. Focus where it counts, that's the strategy. Variance is the difference, actual versus planned. When results don't match, you gotta understand. Favorable means we're stacking more cash. Operating income higher, making a splash. Unfavorable, profits took a dive. Time to analyze to keep the biz alive. Variance analysis, we're digging deep. Favorable or unfavorable, the numbers speak. Management by exception, that's the key. Focus where it counts, that's the strategy. budget variance, the macro view. The level 1 analysis gives us more to choose. Sold 10,000 jackets, but we planned for 12. Revenue is down, got some stories to tell. Variable costs are lower, hey that's nice. Spending less cash is a slick device. Now let's talk about that flexible friend. Adjusting budgets so the data blends. Volume variance shows the output clash. Rate efficiency where the numbers flash. Flexible budget variance, actual versus flex. Same output level, so what's next? Rate variance pops when costs don't align. Efficiency slips when we waste some time. Flexible budgets make comparisons fair, helping us see what's really there. Variance analysis, we're digging deep. Favorable or unfavorable, the numbers speak. Management by exception, that's the key. Focus where it counts, that's the strategy. So keep your budgets tight and your eyes on the prize. With variance analysis, watch your profits rise. Financial savvy is the name of the game. Now you're rocking budgets like a boss, no shame.